Okay, let's continue discussing the investment environment. So let's think about the activities in a bank. Essentially, there are two different kinds of banks that people talk about. Commercial banking is where you take your money, you deposit, you can make loans, you have a checking account, etc. Investment banking is totally different. Investment banking is the process of assisting corporations to distribute new shares to the investing public. So this process is what's referred to as underwriting. And again, this is the process where corporations can become publicly traded corporations and now issue stock to the public, or they could be older publicly traded corporations that want to distribute more shares. All of those transactions occur in what's referred to as the primary market. So there are some terms that we need to be familiar with about financial markets in general. We've already been discussing an investment banker. This is an entity that helps corporations distribute shares to the public. An investment company is a type of a corporation that purchases investments or securities of other companies and creates portfolios. Now, there's two kinds of things out there that are familiar or sound similar with this. The first one is something called a hedge fund. And a hedge fund is a portfolio of securities, but cannot really be classified as an investment company. It has much stricter rules, and it has, as far as investors, and it's only meant to be for wealthy people. So let's move this over here so it's under its own designation, if you will, as an investment company. A mutual fund is what most of us purchase through 401ks, retirement funds, etc. Again, this is a specific kind of an investment company that creates portfolios for other investors to buy. When we get to the mutual fund chapter, we will discuss the different types of investment companies that are available. We already mentioned, we know what a commercial bank is. But another critical institution that we need to be concerned about when we think about investing and finance is to think about pension funds. These are the companies that ultimately administer the retirement accounts that are in corporations that are for the benefit of the employees of those corporations. And venture capitalists are entities that help with funding companies. Typically, the companies that they work with are newer companies looking to expand or, quite frankly, just get started. But these are what are referred to as venture capitalists. So let's talk a little bit about the most recent crisis in the financial industry. And I don't really want to dwell too much in this, but it is important to kind of understand and learn from some mistakes. So if you kind of think about history prior to 2008, this is a time where we had a fairly stable economy. Interest rates were pretty low. The business cycle didn't have big swings up or down. At the same time, we had a historic boom in the housing market. So the housing market was growing fairly rapidly while the United States economy was really a little bit more on the stable side. So how did housing change? What had changed was getting away from the older thrift institutions that made mortgages to homeowners, right? They had fairly strict requirements to be able to get a mortgage. But in general, the older way was an origination to hold. So these institutions created mortgages and they held those mortgages. The newer way is what's referred to as securitization. In this way, they actually were creating securities so that they could distribute mutual fund mortgages and their cash flows to investors. So this was a new concept in thinking about origination to distribute the securities. So there was a fundamental change in the way companies or the way institutions created mortgages. So the process of securitization was basically creating a security that represented mortgages. Originally, this securitization was all about the securitization of what are referred to as conforming loans. That is, they were loans that had strict adherence to loan-to-value ratios, to down payments, etc. But what happened in this new wave was the inclusion of non-conforming, or what they refer to as subprime loans. These had very low, sometimes no documentation. And again, I mentioned they also had rising loan-to-value ratios. In fact, it wasn't uncommon to be able to get a mortgage that was 100% of the value of the house. So this would be 100% loan-to-value ratio. The additional thing that happened at this time was also a reemergence, if you will, of adjustable rate mortgages. So the idea here is you could shop for the kind of mortgage that fit your needs. The challenge is with these, with the lessening of the qualifications for a loan, this created the potential of some loans ultimately defaulting. So essentially the way the security thing works, right? There's a homeowner, they get a mortgage from an origination company. That company then sells to an agency, and that agency sells to an investor. So essentially when the investor buys, the $100,000 ultimately can go back to a new homeowner. The homeowner pays principal and interest, a servicing fee, a guarantee fee, and then ultimately that money gets to the investor. The challenge is what happens when this homeowner defaults, right? They've already received the money, but now the payments to the investors stop. This is the problem that we had in this crisis, where we were giving loans to people that quite frankly couldn't afford to have the loans or didn't have the qualifications for home ownership. So what was created as part of this process was something called a collateralized debt obligation. Essentially, it took these securitized loans and it securitized securities, and it divided them into different types of investments. They refer to them as tranches. So there was a senior tranche that had very low risk, and then they had a junior tranche that had very high risk. The challenge was that these different kinds of investments were all based on the same pool of securities. So how can you evaluate the risk of something when it's really part of this big pie, if you will? So the challenge was ultimately determining the risk of these securities. And it turns out that the securities were vastly underestimated as far as risk was concerned. So again, since default probabilities were underestimated, now we have default. The geographic diversification of securities didn't reduce risk significantly. There were some agency problems with the rating industry, rating agencies. So again, what happened was we ultimately were giving loans that that people defaulted on, and that default created the spin, right? So what we're, as part of this, to help reduce the risk for some investors, things called a credit default swap were created. These are insurance contracts against borrower default. So some of the investors were insured against losses. So when these loans started to default, so many of them defaulted that this insurance ultimately didn't have enough capital to cover the default swap. So now there was a huge crisis in the market, that the credit default obligations, they all almost immediately started to fail. So now we have these securities that are there to insure something, but when that product that was being insured, the mortgages, when they were defaulting at such a great rate, now the insurance didn't keep up with what needed to be paid off, and it obviously created defaults in the banking industry. So this systematic risk, right? One thing failed, and then that created further things. So this created these waves of selling. There was potential contamination. That is, it created this cascade of selling and selling and selling, which was driving down the price of mortgages, driving down the availability of cash, obviously creating a tremendous problem in the marketplace. So to complicate this, the banks themselves had mismatched their maturity and liquidity. So they were so highly leveraged, they didn't have a margin of safety. So they were in a position of an inability to manage the debt and the losses on those loans. So again, a continual breakdown of the industry itself because of initially offering and providing mortgages to individuals who were not qualified or couldn't pay for those mortgages. Investors relied too much on the credit enhancement through these structured products. They were very attractive investments. Most of them were posted with no margin requirements, so you really didn't have to spend much money to get them. There was very little transparency, no regulation, so there was a huge challenge in the market. So in the end, what happened? All of these troubled firms started to break down. The money market broke down. Credit markets froze up. The federal bailout was necessary to help stabilize the financial system itself. So ultimately, how can we fix this? In the end, the challenge in getting things fixed was that we couldn't separate the good things from the bad things. My story about this is, once you created gravy, once you created these different securities with different tranches, different types of off-spun securities that were all based on this one pile of investments, once they were created, you've now created gravy. And you can't uncreate gravy once you make it, right? You can't separate the components again. And that's what caused the major crisis here, was that we had this mixture of things that nobody could separate the good from the bad. So what happened was we had legislation. The Dodd-Frank Reform Act was created. This created much stricter rules for banks. It increased transparency, especially in derivative markets. It created an Office of Credit Ratings to help oversee the credit rating agencies. Now, there are many people who say that this act went way too far In fact, that's the way it always works with new legislation. When terrible things happen, the legislation of the country reacts, and it's almost always an overreaction. So parts of this could probably be lightened up now, but we still need to be sure. When somebody says we don't need regulation, their assumption is that people are naturally good people, that they won't do things in their own best interest and not worry about how that affects the economy in general. And we just don't live in that world. So regulation is necessary. How much? How many different organizations should be regulating an industry? In the end, those are the questions that are the problems with regulation, not regulation in itself. So let's look at an example problem. Right here we have Excelsior Widget Company. They have a piece of equipment for $150,000, and they have cash on hand of $90,000. They want to borrow $200,000 in cash, and they sign a promissory note to pay that back. We would like to prepare a balance sheet for the company and also look at some ratios. What happens is, as companies grow, as time passes, these ratios change. So we have to be diligent in understanding what the actual ratios can mean. And we're going to look at a very simple process here, a very simple analysis, but it brings home a couple of points that we need to discuss and understand when we think about investing. So here's the balance sheet. Our old balance sheet started with $240,000, and we borrowed $200,000. So the total assets are now $440,000. Here's the new loan. So our liabilities and equity are $440,000. The real asset to total assets, right? The relationship of real assets to all assets is about 34.09%. Real assets are the generating assets. That's what creates cash flow. That's what creates value for the company. So 34% of the company's assets are in these revenue making types of assets. I would think that in general, a company would want this number to be higher rather than lower. You want to have a greater amount of your assets invested in cash flow making activities rather than sitting in the bank where you're safe, but yet there's not a high rate of return. Another question might be, what's the relationship between shareholder equity and assets? In other words, how much of the assets of the company are, in quotes, owned by the shareholders? How much investment does the shareholder have in the company? In this case, if you take 240 and if you divide it by that 440, again, we end up with a number. 240 divided by that is 54.5%. So roughly this represents the shareholders of the company own, in quotes, a little bit more than 50% in the company. So another way to look at this is, in a more colloquial term, is how much skin in the game do the owners of the company have? In this case, it's a little bit over 50%. How would you feel about a company that had 60% investment by shareholders versus 30% invested by shareholders? You want the owners of the company to be vested, right? You want them to have a lot of money, a lot of equity, a lot of skin in the game. You might be interested in buying that type of company, or quite frankly, you might be interested in lending that company some money because the shareholders have a bigger stake in the outcome of the company. So again, that's chapter 1. We will continue on.